Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets.
Ice raw sugar in New York. The market since mid-January ran along down the underside of the purple highlighted upper tine, currently 21 even, of the early November 2023 to mid-January 2024 bearish shift pitch walk. In late February for a few days and then again in late March until last week, there had been a strong drive higher over the upper tine, but move up failed the first time at the overhead congestion between 2390 to 2408. And the second most recent time by the combination of the congestion of 2235 area, the declining green highlighted short medium moving average currently at 2243, and the influence of the declining mauve highlighted medium moving average currently 2271. Prices last week started pushing down through the familiar stratified congestion zones between 2140 to 2148, 21 even to 2107, 2069 to 2076, 2047 and 2003. This general zone between 21 even to 2010 also features as a congestion area back between January and February 2017. By Thursday last week, prices are pushed down back within the purple highlighted bearish shift pitch walk and down to test the previously highlighted bright red April 2020 to date uptrend, currently at 2092, and last Friday pushing and closing below it. This uptrend had held the market up back in early March and over the Christmas period last year. This time it looks like it has given way. The next uptrend voyaging within the stratified supports is the pink highlighted April 2021 to date uptrend, currently at 2010. With the bright green August 2022 to date uptrend currently at 1877, some way below. Thus it looks like the bearish purple shift pitch hawk has reasserted itself. But I give it a few more sessions to verify. In the meantime, we have the conditions set with only half the month gone for April to be a possible monthly key reversal. Thus, if we close on the 30th of March either over 2258 or under 2252, a somewhat surprisingly narrow range. Well, if we close either side of those, then we're beyond. Anything in between would have the lesser outside month pattern. Right now, we are very much looking at a monthly key reversal down. Ice Europe white sugar in London. The market at the start of March had been wading through stratified levels of support and turning into resistances above, such that prices had dropped down to below the interesting 625.30 to 602.70 congestion area, and even dipped below the breached but unbroken support of the purple coloured uptrend, currently at 608.5. That's dating from October 2022. There was some further congestion below between 590 even to 592.80, which finally held up prices before we saw a move back up 5 weeks ago. Then, 3 weeks ago, we had a break higher with a daily key reversal up, followed by a 2-day descending hawk pattern, a pattern that's traditionally seen as bullish. And prices punched up and closed over the green highlighted short medium moving average, currently 634.70, using it as a proxy support for a further attempt higher, filling in the mid-February changeover gap between 643.5 and 650. For a little while, it looked like the strongly declining medium moving average highlighted in mauve on my daily chart was giving way. And we did see it being pierced as recently as 2 weeks ago, but there were no 2 consecutive closes over it. There were none. And the medium moving average acted as a cap, held by the 50% Fibonacci line of the January to September 2023 move at 652.20. And we saw prices drop down below the green highlighted short medium moving average, though we are seeing prices rise up to test it even today. Over the last few weeks, I've been voicing a question here that I have been posing to myself. It is the action since early December last year. Is it developing into a double bottom or some sort of wedge or triangle pattern? Last week, it was still too early to tell, but I am more confident now that the late December 2023 to date action is perhaps a possible descending triangle. I've outlined the triangle on my daily chart in bright red, and it's currently 592.80 to 660.30. This is a pattern to watch, just in case it morphs into something else. Sugar white premium spread. Now it must be close to, if not over a year here, that this chart finds many things are still going on all at the same time. Okay, so I'd previously spoken some while ago now about two big picture items seen here on this weekly chart. We have the recurring big old bullish Andrews pitchfork from 2019 to 2021 highlighted in dark blue on my weekly chart, with the lower time below currently at 133 3/4, tested but not broken. Along with many of the moving averages and the congestion between 162 3/4 to 164 3/4 that contains the rising neckline extension of the June 2021 to May 2022 reverse head and shoulders bottom that's currently at 164.5, plus the 2012 high at 164 3/4. There is also further congestion nearby between 173 3/4 to 175. Then topside we have a pretty clear area over congestion at 178.5 up to the dark blue middle time, currently 207 3/4 of the same bullish Andrews pitchfork. Only now, once prices last week made a weekly bullish closing white Mariposa over the September 2023 high, and that's at 171 3/4. Only now will I look topside and consider what might be the topside targets for the big elephant in the room, the big February 2022 to August 2023 diamond top pattern highlighted in green on my daily chart. Thus, a primary target X, which isn't that easy to reach, will be in the 250 even zone, with a secondary hard to reach target X1 much harder to reach, up in the 291 area. I can see myself finessing these at some point, as they are currently both off the top of my weekly chart.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Service International Limited. And here comes the final important bit.